So we're going to talk a little about understanding retirement and recent market volatility, how volatility does affect retirement and investments, and what those strategies are. Does market volatility affect your portfolio, and does it affect your portfolio? Absolutely. And people don't really realize how much it actually does, and we're going to talk about a little bit. So if you experience negative returns early in your retirement, it can significantly reduce the longevity of your savings by a dramatic amount, right? So there is a study by McKinsey recently that said investments that demonstrated early negative returns sooner than positive returns, generally they could run out of money. So how does that work? Well, how it works is if you've got negative returns in the very beginning, it's very difficult to get those returns back in the future. But right now, nearly half of Americans risk running out of money, which is a lot, right? And it doesn't matter. I've seen it happen with people who don't have a lot of money, which makes sense, but I've seen it happen with people up to $2-3 million running out of money just because they didn't know some of the rules of engagement, right? Now, single women have a higher chance of running out of money, but still 40% for single men, 55% likelihood of single women, and 41% for couples. So let's dive in a little and figure out why this is happening, right? Well, for one, market volatility is incredibly impactful. For those of you who remember during the 2007, 2008 financial crisis, workers lost $2 trillion. And it was a nightmare. Most people now, even though it's coming up almost on 20 years since the financial crisis, most people remember exactly what happened. Many people lost their houses. It was a disaster. Market volatility can have a substantial impact on retirement, right? Now, why does it matter more now than it had in the future? Well, let's kind of dive in and figure out why. The biggest reason is shifting responsibilities of retirement. So in the past, we had something called defined benefit plans. Defined benefit plans are plans in which are something like pension plans, right? So everyone remembers that your parents used to tell you, get a job, you stick there for 30 years and you get a pension. That's called a defined benefit plan. You get a benefit for a very specific period of time. Generally, it was 5 years, 10 years, lifetime joint life, right? Now, back in the 90s and before, the majority of corporations, to be exact, 85.4% of them offered pension plans, but it's dropped dramatically. Now only 7.5% of pension plans are in corporations. Most of them are municipal or governmental, right? And some nonprofits, but it's dramatically less. Now it's shifted to something called defined contribution plans. So if defined benefit plans were something that you get the same benefit for a very defined period of time, what's a defined contribution plan? Well, defined contribution plan is a plan in which you're told how much you can contribute. So this year, you can put in $30,500 into a 401k if you're working. They've defined the amount that you can put in. You can put in $8,000 into an IRA or Roth, depending on income limits. They've defined how much you can put in. $7,000 as a contribution if you're under 50, $1,000 for catch-up, right? Which forces people to look at it differently, because now in defined contribution plans, you're actually managing your own funds. And the problem with that is most people can't manage their own funds. Now, why aren't there any more defined benefit plans? Well, the biggest reason is because the government didn't know what to do around people not dying on time. It's the same problem that Social Security is having right now, right? If people are living longer, you have to give them a benefit. If they live longer, then it's problematic. Even for Social Security, in Social Security, it was launched in 1935. The average life expectancy at Social Security's launch was 62 years old. Well, it wasn't supposed to pay out till 65 years old. So they figured at that point that if they were going to be Social Security, if you did live to get it, then you probably wouldn't be getting it that long, right? Well, people lived longer. And this exact issue came over to pension plans because people weren't dying, for lack of a better description, on time. So they had to shift that liability directly to the individual. So now the individual is in charge of these gigantic 401k or IRA accounts that have 500,000, $1 million, $2 million, or sometimes more. And these brokerage accounts are huge because they no longer have pensions for life, right? So what do you do? How do you get in front of this? Well, for one, you're now responsible for it all. It doesn't matter whether or not you want to, you are in charge of your own financial destiny. You need to figure out when you're going to die and if you're going to die quickly, and hopefully you won't have a lot of medical expenses. So let's delve into economics. Why does this matter? And what does economics have to do with market volatility? We have been in something called persistent inflation. Because we have persistent inflation, one of the things that ends up happening is things are a bit more expensive. It started during COVID-19, and then it was exacerbated by the Ukraine war. And there are other issues that came about, right? So the economy was stimulated due to interest rates cuts and also pushing money into the economy, and it caused inflation. Well, inflation causes things to be more expensive. If things are more expensive, then interest rates go up to kind of offset that. Well, if interest rates are higher, then the cost of borrowing money is higher, right? And this all affects the economy. We additionally have geopolitical risks, right? We've got wars. Well, wars a lot of times are centered around oil, right? You've got Russia and Ukraine, you have Israel and Palestinians. There's oil down there, and oil is inherently inflationary, right? So the market doesn't like these geopolitical risks that potentially could either cause the US to be caught into a war that they don't want to be in, or it could cause things on our end to become more expensive, right? And we also have sector specific movements. The market tends to be very fluid. It's not a vacuum. When the market goes down, not everything goes down, but there may be specific sectors in the market that are adversely affected due to whatever's going on in the economy. Right now, we have the top 7 stocks, which are tech stocks that have been screaming forward for a long time, and they're correcting as we speak. So there's always something in the market that potentially can cause the market to go down. Now, how does this impact your 401k, IRAs, and brokerage accounts, right? Well, one of the ways that it does is back in 2022, which people don't remember, a balanced portfolio, which is a 60-40 portfolio, according to Vanguard, it went down 22%. So if you had $1 million in your account, if you looked at your account at the end of the year, you would have had 780,000. Well, what if you were actually retiring in January of that year and you had to take money from that account? If you were working, then you wouldn't have an issue, because what you would do is you would continue to fund your 401k and you wouldn't have to pull money out of it. The issue is at retirement is that you have to pull from your assets and you do not have the time or the luxury to wait it out. The second one is the sequence of return for risk for retirees. So what that means is if you happen to retire in the year that's a down year and the next year tends to be down too, then it can dramatically impact your success for retiring over the long term. Now, of course, there's basic investor psychology and common mistakes. Investors typically like to do the exact opposite of what they've been told to do. So when the market is screaming up, everyone wants to go in the market. When the market comes down, everyone wants to get out of the market. Generally, it should be opposite. When the market's going up, you should wade in with caution. When the market comes down, you should take it as a buying opportunity. But it's very hard to do that because psychology tells us when everyone's leaving the building due to a fire, you should probably run out of the building as well. It doesn't necessarily work that way with economics and with investing, but that's what people generally do. So this is me. My name is Aly McFarlane. I am a managing partner at Wealthfolio Advisors, and we've got offices in San Francisco, Sonoma, and a couple offices in Long Beach. Thank you for joining me today. You can reach out to me by phone on the number on your screen, or you can email me if you'd like to see me to ask any more questions or to set up a time to discuss this more.